So do you feel that you're paying too much in taxes? Are you wondering, how can I plan for taxes so I'm not surprised by what happens, or I'm aware of strategies that might help me? I'm Eric Walters, Managing Partner at Summit Hill Wealth Management. We're going to talk about year-end tax planning. This is something that we do with our clients to help make sure that they are aware of what their taxes will be next April or October, and also that they evaluate opportunities that are in front of them before the end of the year when it's too late. So first, why is it important to do tax planning? Well, there's a couple reasons. One is that the IRS will not do this for you. And many CPAs will do tax planning if you ask them, but they're often hesitant to charge that additional hourly rate. You usually need to invite your CPA into proactive tax planning. And thirdly, kind of most importantly, if you're a successful family or business owner, taxes are usually one of your largest expenses. We have estimates for clients looking over from retirement till the end of their lives that they'll pay $2 to $4 million in state and federal taxes. That's just over, a 25-year tax horizon. If you're younger than that, you could pay significantly more in taxes. So it matters because this is your money and there are legal ways for you to lower your tax bill. And what we're going to talk about is both personal strategies and strategies for business owners. So the first thing to do is look at your own financial situation. If you have a balance sheet, pull it out and look at those big categories. If you own a business, if you've got investment accounts, if you've got other assets like IRAs or real estate, you want to pull it out and then look at last year's tax return. So go ahead. Pull out last year's tax return. Usually at the front of the return, most CPA firms will have a comparison year over year and just look and see what changed for you. And the things I'd encourage you to look at is what was your total federal tax divided by your adjusted gross income. This is your effective tax rate. So for example, if you paid $100,000 in taxes and your adjusted gross income was $1 million, your effective tax rate is 10%. That's the effective rate. Now, we have a marginal tax system in the United States, so as you earn more, additional income is charged at a higher rate. So some people will say, I'm in the 22% tax bracket, or I'm in the 24% tax bracket, but not all of your income is charged at that level. Early on, it's at 0, and then it might be at 12, and then 22, and 24. So an effective tax rate is a good idea of just saying, what's the effective rate? And then look through your tax return or that summary and just see, did you take the standard deduction or did you itemize? If you had a number of, let's say charitable gifts or mortgage expense, you may have itemized. After the Tax Cut and Jobs Act, a lot of people are taking the standard deduction. And then were there big changes in income? Did you have a big capital gain? Was there a sale of a business? Did you have unexpected income boost or income drop? So it's just important to find out what happened last year because that's going to set the tone for this tax year, 2023. So if you've looked through your tax return, you've got an idea of what your effective tax rate is, you've looked and seen what kind of deductions am I getting, and then finally, let's think about above the line deductions. Were there a contribution to HSAs? Was there other changes in that small category of kind of above the line deductions? And this is what determines your adjusted gross income. There's not very many of these above the line deductions, but if you look on your tax return, there'll be the first couple lines to see, are you getting any of these deductions? So now that you've got an idea of your own balance sheet, and then how that balance sheet created taxes for you last year, now it's time to think about this year. And so first, we'll think about strategies for wealthy families. The first thing is charitable giving. If you are a charitably inclined family, good for you. That's awesome. You are helping people that need help. But there are ways to do it that help save you in taxes. A lot of people, when they make charitable gifts, will make with a check or a credit card. That's wonderful, but there's a better way to do it. I just talked to a client in September. He wanted to support a charitable organization, and he said, I wrote him a check for $10,000. That's great, but it just so happened that he had an appreciated mutual fund that if he had donated that mutual fund to the organization, they would have gotten the exact same amount, but he would have avoided paying capital gains tax on that appreciated asset. So first strategy is, if you are charitably inclined, think about donating appreciated stocks, ETFs, mutual funds. That's a great way to still support the organization but you won't pay capital gains tax on that appreciated asset. This is especially true if you have a concentrated position in a stock or mutual fund that someone like me, your financial advisor, is saying, we would like to get rid of this. That's the perfect thing to donate. So please donate it. Stop writing checks. So think about appreciated assets. This also can include cars. If you don't need a car, not necessarily appreciated asset, but if you don't need one, if you have collectibles, if you have real estate. Now talk to your CPA before you try to donate any of those, because those require some special evaluation and appraisals in order to be a valid deduction. But if you don't need those things and your family doesn't need them, you can avoid future taxes on them. The other idea is that if you have had a large liquidity event this year or capital gain, this is probably in the hundreds of thousands or millions of dollars if you sold a business. If you are charitably inclined, there is a tool called a donor advised fund that you should consider using. A donor advised fund is a 501c3 charity that is chartered and registered with the United States IRS. It's usually operated by a major financial firm like Fidelity or Schwab. And what you do is you contribute funds into this donor advised fund, you get a tax deduction the year in which you make the contribution. Then the financial institution holds those funds for you. You can invest them and try to grow them, and then distributes them in the future. And the way we use this with clients is, let's say you sell a business, $10 million, and let's say you have a $2 or $3 million capital gain. If you're already charitable, many of our clients will say, well, we already make, let's say $50,000 or $100,000 charitable gifts per year. Why don't we take multiple years of charitable contributions and kind of put them in the donor advised fund? The same year in which you have a big capital gain, you get a big tax deduction. And then you can still send out that $50,000 or $100,000 or whatever amount you want to those organizations. So they still get your support. You don't get a second deduction when you send it out. Your deduction is the year in which you made the contribution. But this is a great way to offset a huge capital gain. And rather than send that money to Uncle Sam, you can keep sending it to all those great organizations that you want to support. A related idea is that you can set up a private foundation if you want to support people or organizations outside the United States. So a number of our clients are of faith, and they like supporting faith-based institutions that are abroad. These are like missions or missionaries. But you can't give to them usually directly unless they're affiliated with a US-based charity. If you've got those international recipients, a private foundation can be right for you. There is a great organization called Foundation Source that I'll give them a shout out. They can do a great job helping you set up and manage a private foundation. But there are caveats to running a private foundation you want to be aware of. It's not as easy as something like a donor advised fund. So it's a good idea, but just make sure you talk to your CPA or advisor about that. Now, the other thing that we looked at last year was deductions. Now, there is a standard deduction. Last year it was about $14,500 for a single person, and for a married couple it was about $28,000. This year those amounts are going up slightly to about $15,000 and $30,000. Now, if you are charitably inclined, or if you have medical expenses that are a larger portion of your adjusted gross income, you may try to itemize your deductions in a given year rather than just take the standard deduction. So talk to your advisor or CPA, and basically what you can do is to try to bunch multiple deductions in 1 year to go above that approximately $30,000 married deduction. And this would mean you look at paying your property taxes twice. Many municipalities allow you to pay, let's say in January and then again in December, so you pay them in 1 calendar year for 2 different calendar years. You would also kind of increase your charitable donations in that year and try to kind of get maybe a few years. You could do that with a donor advised fund. And then also you would look at, of course, property taxes, I already mentioned that, and also state taxes as well. So you can try to bunch that. This is effective if you often are kind of close to, the potential for itemizing. Try to bunch them. Or if you have a year in which you have a lot of medical expenses, or you're going to make a big charitable gift like a donor advised fund, kind of bunch it in that year. The other thing that if you look back, hopefully you saw whether you had many capital gains or losses. For this year, you can look and see if you have positions in taxable accounts or revocable trust that have a loss on them. And if you, your advisor, sell this, you'll realize a loss, and that can help reduce your year-to-date capital gains. And then also you just want to be careful on when you kind of sell assets that will trigger capital gains. You or your advisor should be able to kind of think, if you're going to be raising money for a particular distribution or for retirement, the assets that have larger capital gains, you usually can offset that with assets that don't have as much capital gains. So think about tax loss harvesting, and then also think about being careful and strategic about when you're selling assets, for your own spending. Then, if you have not maximized your contributions to retirement accounts, this is your shout out. You should do it. You can still make a full year's contribution to something like a 401k before the end of the year. If you are a business owner, you can look at what's called a SEP IRA. You can talk to your CPA about whether you're qualified for that. You can make a contribution to a SEP into next calendar year for this tax year. You do have to make sure you're qualified, but SEPs are amazing. You can, if you are a solopreneur, set up and use a solo 401k. You can also use a traditional deductible IRA, and we love Roth IRAs. So, there are a lot of good options if you are interested in setting up a 401k for your company. You can let us know. We help companies do that. If you have not contributed the maximum, do it. Many retirement plans are set up to give you an additional deduction, a contribution, which reduces your taxable income. And then even if you don't have a formal 401k or 403b, you can use things like IRAs, SEP IRAs, things like that. Now, if you have a family that has a larger net worth, this would be kind of more like 20, 25 million, you may be aware that in 2025, the tax laws are set to sunset and you will not have as large of an exemption from estate tax. So right now, each person has approximately about 12,500,000 exemption from life gifts, so just money that you want to pass on to people during your life or after you've passed. If you've got about 25 million as husband and wife or family, and after 2025, the tax law is changing and that amount will drop quite a lot. So one tax planning idea is that you can talk to your CPA or your advisor about something called annual gifts. This is an amount of money that you can give to family members or friends. You don't have to report it. For this year, it's about $16,000. You can make annual gifts, and we encourage clients to start giving away their funds in a small, reasonable amount. So if you have multiple kids and grandkids, you can give out, 100,000, 200,000. If husband and wife kind of put that together, it's about 32,000. And then you can give that to children, you can give that to grandchildren. And this is just a good way to support your kids and grandkids and also kind of lower that taxable estate. So those are some personal strategies. So what are some strategies for business owners? Well, I've already mentioned one, and that's set up and use a retirement plan. There's a huge amount of options there. And if you set up what's called a safe harbor plan, where you agree to contribute either a portion of someone's salary or match a portion of their contributions, you don't have any limitations on how much you as the owner or partner can contribute, and you can contribute the max. Then you can also set up a retirement plan to have kind of an extra layer of savings, and that's called a profit sharing plan, where you modify the terms of a retirement plan to allow you as owners to not only share some profits with employees, it doesn't have to be a huge amount, but then that allows you as owners or partners to set aside even more of profits. So consider setting up a retirement plan. Again, this is something we do for business owners, and we can help you explore your options. Another option is to set up employee benefits. Now, a lot of owners I talk to will say, well, that's pretty expensive. But it's a deductible expense as a business, and so that reduces your taxable income. It's also a great recruiting tool, and as a business owner, what I want you to be thinking about is that for you to retire, you eventually have to turn this illiquid thing called a business into a sale in some way. And one of the best ways to make sure you have a sellable business is to keep and retain great people. So offering benefits is a great way to do that. Now, if you own property that you either use for an investment as a real estate investor, or if you own property that you operate out of, you may benefit from something called a cost segregation study. And this just means the IRS has published schedules of how much of property, including real estate, you can depreciate each year. And that depreciation expense reduces your taxable income at the business level. Now, if you do a cost segregation study, you hire a team of specialists. They're usually kind of building engineers, and they look at each part of your building and determine if you can kind of have a larger depreciation expense. And usually what this means is that they would have a shorter lifespan. And if you go through a cost segregation study, you may be able to have a higher depreciation expense, which can lower your annual taxes. Also, if you're in a business where you are consistently kind of looking at different products or services to provide, you have to do research, you're investigating different business lines, you may qualify for the R&D tax credit. A lot of people think the R&D tax credit is only for manufacturers or for technology companies, but that's not true. Now, there are caveats, and you do need to work with a qualified CPA, but many firms, if you are just developing a new process and doing research or offering a new product, you may benefit from the R&D tax credit. So check it out. Just tell your CPA, here's the work we've been doing to offer a new product. Here's the work we've been doing for a new service. Can I qualify for the R&D tax credit? And a good CPA will help you through the process. Finally, each state has state tax credits. This is where they support different businesses, kind of in different areas, whether it's geographic, they want to support businesses in a certain area, whether it's a type of industry or a size of a company, or if you've hired people or retained people through a downturn, you want to be aware of these state tax credits. So each state will publish just a long list of state tax credits. So look at it, ask your CPA, can you help us look through this? I've had clients that have found tens of thousands of dollars in tax credits just by looking through a list, and they'd say, hey, we do manufacturing in this part of town. Does this work? Or their CPA said, hey, we were thinking about this. So take a look at that. It's worth researching. Now, while we're on the topic of business taxes, you should make sure to talk to your tax advisor if you qualify for the Qualified Business Income or QBI deduction. This is too complex for me to get into, but certain businesses and certain industries do qualify for a tax deduction kind of right off the bat, just based on how they are organized as a business. Now, if you are a business owner or an executive and you have a low income year, maybe this is, maybe business results are not that great this year in terms of net income or profits, or you've sold a business or you're between jobs as an executive, you have a low income year, maybe normally you're earning hundreds of thousands, maybe $1 million, and then you're just kind of between things. Make sure to talk to your tax advisor or your financial advisor before the end of the year, because a low income year can be a great opportunity for you to benefit from different credits. You can consider converting some of your IRA or 401k to a Roth. There's other options that you can engage in a low income year. I mentioned capital gains. Let's say you've got a portfolio that has a few positions that have large capital gains. If you have a low income tax year, this is a great year to take some of those capital gains, because it's not going to trigger as much capital gains as it would in a high tax year. So think about that. If you are in a low income year, either business results are down or you're between things or you've sold, make sure you think about it before the end of the year. Now, I've just given you a survey of some of the most common ideas that we work with clients. Clearly, there's a lot out there, but the process of tax planning should be annual. We like to do it in November and December of each year. You should look at last year's tax return. You should ask what happened last year, what may change this year, and ask these questions. Ask your CPA to help you. If you're working with a good financial advisor, they should be doing this. If you're not, direct message us. We would love to take a look at your tax return, offer some ideas, and just show you how we interact with clients systematically throughout the year to ask questions like this to make sure they are well cared for. So the thing to do, pull out your tax return, look at last year. Now, ask these questions about deductions, capital gains, look at charitable gifts, look at your potential deductions for this year. Think about if you've maximized your contributions to retirement accounts for this year. If you're a business owner, I gave you a number of ideas. You may not be able to implement them, before the end of the year, but it's good to ask the question. R&D tax credits usually are available on an annual basis. So talk to your tax advisor and let us know if we can help you ask these questions and try to legally lower your taxes. I'm Eric Walters, Managing Partner for Summit Hill Wealth Management. Thank you for your time. If you have any questions, comment below. I would love to hear other topics you're interested in. If you loved it, please give us a thumbs up. It really helps us, and we'll look forward to seeing you in the next video. Thanks.